Welcome to the weekly close edition of Storm Stock Solutions. I'm Grant Mercer. We're wrapping a week where the headline indices felt steady on the surface, but underneath you had a tug of war between AI euphoria, legal shockwaves on tariffs, and some very real cracks in pockets of biotech and high-octane cloud. Let's bring some clarity to the chaos in these markets. At the very top of the storyboard is Nvidia and the broader AI trade. According to options strategist Lawrence McMillan at MarketWatch, Nvidia's options are now priced for almost a perfect earnings scenario next week. Implied volatility, skew, all of it says traders expect big movement and very good news. When a single stock becomes that central to the AI narrative and to the S&P 500's momentum, that kind of priced for perfection setup matters. It tells you expectations are stretched. Any wobble in guidance, margins, or AI commentary can ripple across chips, big tech, and even passive index flows. But AI wasn't the only story. We also saw a stark reminder of downside risk in more speculative corners of healthcare. Tomi Kilgore at MarketWatch reports that Grail, once a hot name in early cancer detection, was the Nasdaq's biggest loser after a key trial of its Gallery test failed to hit its primary endpoint. The stock was essentially cut in half. That's classic binary biotech risk, years of optimism unwinding in a single headline. For the week's narrative, it highlights just how uneven this market can be. You can have AI megacaps marching higher while smaller. High expectation stories see brutal repricing when the data doesn't cooperate. Stepping back to the macro, this was a week where the Supreme Court reshaped the tariff landscape, but not in a way that gives anyone simple answers. Philip Van Dorn at MarketWatch framed it around two big trends investors are trying to ride: the sustained dominance of a narrow set of high-quality leaders, and the hunt for resilient income through vehicles like business development companies. Both of those trends intersect with trade and inflation, so the court's decision looms large. Robert Posen writes that while Trump's tariffs have been knocked out in court, small businesses aren't suddenly getting a do-over. Years of higher input costs, disrupted supply chains, and squeezed margins don't vanish with one ruling. The damage to Main Street balance sheets is done, and many of those firms had to raise prices or cut investment just to survive. Meanwhile, Andrew Keshner points out that even though many of those tariffs were struck down, consumers shouldn't expect a wave of price cuts. Companies have already repriced goods, shifted sourcing, and in many cases, discovered they had more pricing power than they thought. So the legal win doesn't necessarily translate into cheaper shelves at Walmart or Amazon. That explains why consumer sentiment can still feel fragile even as headline inflation numbers cool. On top of that, reporting from Robert Schroeder and Victor Reklaitis zeroes in on two big open questions: refunds and replacement tariffs. Will companies that paid billions in duties get any of that money back? And if the old legal framework is gone, what new tools will the administration use if it still wants to pursue a protectionist agenda? Those unanswered questions kept a lid on what might otherwise have been a clean "tariffs are gone, everyone wins" rally. You see the nuance clearly in retail. Bill Peters at MarketWatch notes that brands like Target, Nike, and Hasbro could be significant beneficiaries if effective tariff burdens fall. Lower import costs are a real tailwind. Yet stocks of retail giants like Walmart and Costco weren't exactly exploding higher. Markets are telling you investors are skeptical that tariff relief will immediately flow through to margins, especially if consumer demand is cautious and new forms of trade friction are already in the works. Let's talk winners and themes. On the positive side, Van Dorn's piece on those two big stock market trends is almost a roadmap for how a lot of professionals are thinking. First, stay tethered to durable, profitable leadership, whether that's in AI, cloud, or other high-quality growth. Second, look beyond broad indexes for income and diversification, including sectors like business development companies that can offer yield plus exposure to middle market lending. The strength theme this week wasn't about chasing meme names. It was about gravitating toward quality and cash flow in an uncertain macro. Another relative positive came from Keshner's analysis. While consumers shouldn't bank on lower prices right away, the dismantling of key tariffs at least reduces one structural source of cost pressure over time. For cost-conscious households and margin-sensitive companies, that's better than the alternative. It adds a modestly constructive tone to the medium-term inflation story, even if the short term is messy. Now, the pressure points. First, CoreWeave. Christine G reports that CoreWeave's stock dropped as a multi-billion-dollar funding arrangement, with Blue Owl reportedly hit a snag. Lenders are uneasy with the company's below investment grade profile. And that suddenly puts a question mark over how a capital-intensive neo-cloud player continues its rapid expansion. This is more than just one stock. It's a live test of whether the market will keep generously funding every AI-adjacent infrastructure story, or whether financing will start to bifurcate sharply between high-quality balance sheets and everyone else. That's a pocket of the market to handle with care. Second, the Grail trial failure. A stock being cut in half after years of optimism is a gut check for sentiment in high beta growth and pre-profit biotech. It reminds investors that not all innovation trades are created equal, and that in some areas, one data readout can overwhelm every macro narrative. There's also a quieter but important risk in consumer psychology. While not all of it is captured in this week's headlines, you can connect the dots, tariffs, sticky prices, and the reality that many households don't yet feel post-inflation. Analysts are asking whether even a legally cleaner trade regime will be enough to convince consumers that the worst is behind them. That uncertainty can weigh on discretionary categories and housing-related names, even when the hard data still looks solid. Let's pull the macro and policy picture together. This week's big story at the policy level is that trade is being rewritten by the courts, not just by the White House. The Supreme Court has signaled clear limits to one legal route for sweeping tariffs, but the administration is already exploring other avenues. For markets, that means volatility around trade isn't going away, it's morphing. Companies that are heavy importers, retailers, industrials, some tech hardware names, are trying to model what a post-ruling tariff regime will look like and who ultimately eats the costs. At the same time, the AI and big tech complex remains the gravitational center of equity markets. Nvidia's dominant role, underscored by its investments in the AI ecosystem, and now by this priced-for-perfection options backdrop, makes its upcoming earnings an informal referendum on the entire growth trade. Layer on top a consumer that's still wary and small businesses still nursing scars from trade wars, and you have a market leaning on a relatively narrow set of winners in a still complicated economy. Before we look ahead, let's hit the under-the-radar setups I'm watching going into next week. First, Nvidia options themselves. Macmillan's work at MarketWatch shows just how elevated expectations have become. I'm not giving you an option strategy here, that's for professionals and personal planning. But as a sentiment gauge, it's powerful. If we see volatility in AI names before the print, that could be traders hedging or unwinding positions into this very high bar. Second, Grail's collapse is a sleeper in another sense. It may prompt investors to re-examine risk across early-stage health tech and diagnostics. You could see a ripple of de-risking or conversely some bargain hunting. Either way, it's a corner of the market that might matter more if we start to see clustering of disappointments. Or on the flip side, a few high-profile trial wins. Third, the tariff refund question. Schroeder and Reclatus stress that no one yet knows how or even whether refunds will work. If Treasury and trade officials start to outline a path, that could turn into a meaningful story for certain import-heavy manufacturers and retailers. Until then, it's background noise. But it's noise that could become a signal quickly. Looking ahead to next week, here's the setup. Earnings, led by megacap tech and AI, are poised to take center stage with Nvidia at the heart of it. Traders will be watching not just the numbers, but every word of guidance on AI demand, cloud capex, and data center investment. On the macro side, expect more analysis and possibly more political heat around the Supreme Court's tariff ruling, small business fallout, and any hints about new trade tools. And in the background, keep an eye on funding conditions for speculative, capital-hungry names like CoreWeave. That's your canary in the coal mine for risk appetite in the AI ecosystem. We'll dig into all of that in our Sunday recap and set you up before the next opening bell with our pre-market brief. I'm Grant Mercer, and this is Storm Stock Solutions. Remember, this is information and education, not personalized financial advice. As always, I'll be here to keep clarity through the chaos of these markets. On behalf of Storm Stock Solutions, I'm Grant Mercer.